Hi, in this video we're going to give a basic introduction to accounting and ratios. So first, what is accounting? Very simply, it's a system that allows us to keep financial records, easy access, standards that everybody understands so that I can compare one financial statement to another. In accounting, we generally use what's called GAAP, generally accepted accounting principles. Not an earth-shattering term there, but it's a well-understood system so that we can compare one financial statement to another. So two terms to get us started, and these are stock and flow. So stock is the financial resources available to a company at any given time. I like to think of stock as a snapshot. It is a picture. It's something I have in my pocket at this moment. I have today $20. I wish. That is stock or a snapshot. The other one is called flow. Over a period of time. So I might say in the last week I earned $20. This is a video. Stock is a snapshot. Flow is a video. And for our purposes, we're going to look at two basic financial statements. They're the most commonly used ones, the balance sheet and the income statement. So first of all, the balance sheet is what the organization owns and owes at a given point in time. So back to our flow or stock words. This is a snapshot. It's a given point in time, so this is a stock measure. A couple things that are on the balance sheet. First are assets. And these are things that the company owns. It may include cash, equipment, and it can also include intangible things such as trademarks and copyrights, names, and patents. Within assets, we actually have two types. One is a fixed asset. This is not easily converted into cash. So like a gigantic factory, for example, will be a fixed asset. You just can't go sell that on the street and convert to cash. And then current, which is something that can be easily converted to cash. So cash, to be simplistic, is a current asset. Inventory in a store is a current asset, something that can easily be converted. Traditionally, we thought of assets as something on the left side of the balance sheet. As stuff has become more electronic, that's not as relevant as it used to be. The other piece we have is liabilities. Liabilities is what a company owes. So in our little example here, we see Darth Vader still owes money on the Death Star. This can, similar to assets, this can be current, which is something that has to be paid soon, in 30 days, or I'm going to give you a specific term, something has to pay soon, or long term, that's something due over a longer term, a 30-year mortgage, for example. So in our example, is the Death Star an asset or a liability? It could be both. If Darth Vader owed money on the Death Star, it would be a liability. But if he owned part of it, it's also going to be an asset. It also has some value that he could convert. The final piece on the balance sheet is equity. And this is the value of the owner's investment in the company or the organization. Take, for example, go back to our Death Star. If Darth Vader got a loan from the bank for $5 million, and he's paid off $2 million, so he now owes the bank $3 million, but he owns $2 million of the Death Star. So his equity in the Death Star is $2 million. Key principle here. On a balance sheet, assets equals liabilities plus equity. Always, 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 and forevermore. If you're looking at a balance sheet and your assets do not equal liabilities plus equity, fire your accountant. They are doing something wrong. Always must equal to each other. The other financial statement we're going to look at is an income statement. An income statement reports all expenses and income during a business period. It's the difference between two over a period of time. It's a video. The income statement is our flow or video statement. So let's look at some examples. And these might be a little bit hard to read, but just to give you an idea. So this is Nike. So we see here This is the balance sheet, so we have things like cash, assets. Remember I mentioned that was a balance or a balance sheet item. Okay, at any given point in time, I can put assets in my pocket. It's not over time. Here's Nike's income statement, so things like revenue. So revenue is not in my pocket necessarily, it's over a period of time. In this case, it's 12 months. Amazon, we see here assets, liabilities, equity. This is a balance sheet. This is a snapshot or stock. And if we check this, we would see that our total assets right here equals our total liabilities, which we'd have to do a little math here, plus our equity. eBay income statement, revenue over a period of time, profit over a period of time. It's a video. It's always a time frame, again, 12 months here. Ratios are ways we often look at financial statements. Ratio is basically the relative magnitude of two selected values from financial statements. These are important because also a single number in isolation can be meaningless. For example, you might say revenue of $5 million is good unless you had expenses of $10 million, and then it's not so good. Similarly, it allows us to compare companies in the same industry that are different sizes. So Nike is obviously a lot bigger than Corner Joe Shoemaker. But Corner Joe Shoemaker may actually be in better financial health because their ratios are better. These can be expressed as decimal or percentage, as they're indicators of financial health, and they allow comparisons to other companies. In our next video, I'm going to go through 7 specific ratios you're going to need to know for this class and how to find them.